Hi, and welcome to the Macro Show. In today's episode, we're going to try to figure out, are crashing incomes threatening the recovery? What's going on with these unemployment reports? Why is the soft manufacturing survey data in such a disagreement with the hard data? And what does that mean? Has housing markets peaked? Is the Fed overshooting its target? And why are Treasury Options in such high demand if all there's going to be inflation? And did we nail the call on the reverse repo? I've got some more evidence on that, plus this week's banking data. I'm your host, Steven Van Metre, and as always, thanks for joining me today. Now, I do have a special announcement. Some of you have been waiting for the part 2 of my interview with Corey Clevedon. Now, in this one, you're going to get some real personal information, stuff that only as of this time, unless you've already watched it or listened to it since it's been out on Twitter a couple hours ago, you'll learn some very personal things about me that I learned about myself over just about a year ago. Things I didn't even know. My whole life had no clue. Had some things that I thought I didn't understand, and how actually a fan of this show helped me get the answer. And what I did, how I adjusted, how I adapted, changed my business to deal with this. And I think it's a wonderful story of, in life and in business, whatever we're doing, in our relationships, we're going to face problems. It's how you adjust, how you adapt to that makes all the difference. So I will link to this interview in the description below. I hope you enjoy it over this Memorial Day weekend here, at least in the United States. All right, let's get right into the data of what we've got. And let's start out with these payroll reports. What's going on with these payroll reports? And initial claims, good news, have dropped to 406,000. But remember, do you remember what the typical number should be? 2 to 250,000. Low 200,000s is your typical number of initial claims you should get in a healthy economy. And we're at 406. Now, what's the conundrum here? If employers are saying there's a major labor shortage, why are people still getting laid off? That's the part that doesn't make sense to me. Let's take a look at the total pandemic claims. Now, they're down 175,000. So this has been my metric for the unemployment report. We're down to 15,800,000 people on some form of total claim, which would suggest that this upcoming pay report that we'll get next Friday will look pretty good. But remember, on Wednesday, what did we look at? The Dallas Fed data that said, hey, not so quick here. Maybe that next payroll report isn't going to look so hot. So I still kind of confused is why are people going off these pandemic claims at this point? My understanding is they could still be on them. There are the states that have said they're going to cut them. That's not happening until, I think, as early as mid next month. So what's going on? I don't know. Are people just being kicked off it because they don't qualify anymore? Is that possible? Is this? What are we seeing? Gig workers perhaps going off this? I don't know. Still a lot of questions being answered, and a lot of eyes will be on that payroll report next Friday. Let's go on to what's going on with this manufacturing data. So we've got these durable goods new orders, and where are they here? They're down 1.3% in April. Now, this doesn't make a lot of sense because you might remember we've been looking at, and we will look at next week, the ISM report on business. The manufacturing PMI comes out the first week of the month. And what are purchasing managers saying? Oh, hey, there's a ton of new orders. Well, guess what's in this new order category is durable goods. Now, it's not all durable goods, but there's definitely durable goods in here. So purchasing managers, when they're filling out their survey, are saying, hey, things are just up and up. We're loaded with orders. We're getting more orders. We're at record amounts of orders. And yet the government data says, that contracted last month at about 1.3%. So we're seeing something in the hard data that is in opposition with the soft data. So does that mean we're about to see the soft survey data head lower to play catch up with the hard data? I think that's what we might see. Should be interesting to find out if that happens when the report comes out next week. What else do we have here in our, Thursday data? Let's go, pending home sales. Now, one thing I've mentioned is we're potentially at, peak housing. I mean, is this it? I mean, we've seen these big prices. We talked about this week how home buyer sentiment is tanking. In the recent University of Michigan survey that came out today, going back for a couple months, we see the same data that people are saying, hey, look, I'm not interested in buying a home anymore. And yet people are still buying homes. So that doesn't make a lot of sense. But have we seen the peak? We'll check this out. And here is the pending home sales report that measures the change in the number of homes under contract to be sold but still awaiting a closing transaction. And here's the peak that actually is in late 2020, and you can see where we are now. And I actually pulled this all the way, see the max. I went back as far as I could to show you that we actually had peak pending home sales going back as since this data was at least on here on investing.com since 2001. So we're seeing a slowdown of pending home sales. Is this about to drop off a cliff if all of the survey data is indeed correct? So that should be very interesting, because where the housing market goes, well, the U.S. economy is not far to follow. Let's take a look at the Kansas City Fed Manufacturing Index, expanded at a slower rate. Now, why is this important? Because when we look at these manufacturing surveys, whether from the Fed or from the ISM or from market, we're looking for where these things have peaked. And we know that where these manufacturing surveys start to peak, well, you get stock market peaks and treasury yield peaks within 3 months of those. Now, we're not using the Kansas City Fed as our barometer. We're using the ISM, but you can see, hey, we have a potential peak last month telling us that perhaps this is and the peak in the market, the peak in yields. Now, we have a reason to believe there's a peak in yield because yields have been falling slowly since March. They're down off their March highs. We've got a 7-year note auction. Let's come back to that in a little bit. I've got it loaded up here. And move into Japan, and we're again now looking at inflation data. Why does this matter? Because Japan set the path for what we're doing here in the United States with quantitative easing, fiscal stimulus that in the United States it's believed will be hyperinflationary, and yet Japan's been doing this for decades. And what do we see? Tokyo CPI minus 0.4%. That's deflationary on a year-over-year basis. Even excluding food and energy on a month-over-month, it was flat. So neither inflationary, neither disinflationary. And core CPI here, excluding food and energy on a year-over-year, deflationary is 0.2. So Japan is not able to create inflation, and yet the U.S. allegedly is going to create hyperinflation heading down the same path. You can kind of guess how that's going to add up. We're going to move over into the Eurozone now, head over to France. We've got some preliminary CPI data rising from 1.2 estimated to 1.4, so we'll keep an eye on that. And over in Italy, we've got some hot producer price. Remember, this is coming out of the factory from 2.7 to 6.5. So prices coming out of those Italian factories. Maybe that's your Italian supercar you got on order. Prices are headed up coming out of the Italian factories. And into, let's see, and something in the Eurozone. Well, let's keep going into the U.S. data for today. Now, we have personal consumption expenditures, and a question will come up is, what is that? And how is it different than what the CPI is? Because the PCE is the Fed's preferred gauge of inflation, and it went up at 0.6% month over month. That's a pretty good number. We would expect to see maybe somewhere between 0.1 to 0.3, and that took the year over year from 2.4 to 3.6, meaning that's over the Fed's target of 2% inflation. So what is the difference between these two? Well, when in doubt, head to your favorite search engine, and you'll find out that the CPI measures a change in your out-of-pocket expenditures, right? That's what you're used to experiencing when you go to the store. So of all urban households. Now, the PCE index measures the change in goods and services consumed by all households and nonprofit institutions serving households. Think of this more coming out from the factory level. So the Fed likes to look not at the end user, but from the factory perspective. And what we find is, wow, 3.6% year over year, excluding food and energy, it dropped only down to 3.1%. So definitely U.S. consumers are experiencing inflation in terms of rising prices. But is this transitory and about to roll over? Well, that's what we should start seeing in the June data. So perhaps the May data, we might start seeing it. We might. But we should start seeing it in June for sure, because that's when those base effects get washed out. Now, let's go over into this personal income, get to our headline story, because this really matters. And when you think about, okay, what's driving inflation? So why do personal incomes matter? Because when incomes are going up, when they're bullish, right? When your income's going up, what do you tend to do? Spend more money. So how have incomes been rising, let's say in the last 12 months? But more importantly, recently, through government transfers. So we know consumers, taxpayers are getting government transfers and just driving their incomes up, and they've been spending them. So what's going to happen when those incomes go the other direction? Now, the belief right now is that we're going to have inflation. We're going to have hyperinflation after that. There's going to be this big economic boom. And we just saw in the survey data, and wait till we get to the University of Michigan data. We haven't gotten there, but there's some very interesting things in this. But we talked about that home buying sentiment. Why is it down? Because when incomes go down, guess what? Consumption drops. And look at this. We had this huge 1 month drop. Now we're going to the Bureau of Economic Analysis. I was going to say Bureau of Labor Statistics, but that's not the same. Current dollar, look at this. In April, minus 13.1%. So you see in March, incomes went at 20.9. So there's your demand for March and potentially leaking into April. But incomes are dropping now without government transfer. So what is going to happen to spending in the months that follow? They're going to go down. What should we see with this number? Can we predict where personal incomes are headed in the coming months? Well, they're likely to go down because stimulus checks are fading. Now, that I understand they're not all out yet, but we should see incomes go down. And look at this disposable personal income. So that's interesting, down 14.6%. That's substantial. You see your income go down 14.6%, you're going to spend less. Here you see the Fed's PCE is 0.6 and 0.7 and on the year over year. So when I think about, is this inflation story sustainable? Is this demand story sustainable? And I look at that data, it's hard to connect those two together and say, yeah, that makes sense. Incomes are dropping and demand is going to go up, and that's going to put upward pressure on prices. No, the opposite thing's likely to happen is all of these goods that we've talked about, the Port of Los Angeles being flooded with container ships, and what's going to happen? All those products are going to get out. All those goods and services are going to get out in the economy at a point where incomes are falling. When your income falls, what's your normal tendency? Spend less, especially if you're in one of those 22 states. At some point, we're going to talk about how they're going to lose that extra $300 a month benefit. So if you know that that's going away, how does that change your spending habits? You can turn into savers, because all of a sudden you're saying, wait a minute, my benefits are going to be decreased, my income's been decreased, and I don't have a job yet. I better start saving. That's the key. So let's go back to the economic data. And so you look at this, you're hard pressed to say, yeah, there's going to be a ton of inflation and a ton of demand, because look at personal spending in April, month over month. Now it only went up 0.5%, but it went up 0.5% from a big number. So that's telling us that perhaps April, we're going to see the end of this demand story as incomes go down. And what's another thing that's interesting to me is retail inventories. You hear retailers through these factory PMI reports saying there's a shortage of inventory, and yet retail inventories, excluding autos, were up 0.5%. They're up 0.7% the month before. So are retailers worried about a big flood of demand? Possibly. How about wholesale inventories? From 1.1 to 0.8% month on month. So even wholesalers have more inventory. I find that very interesting. Let's take a look at the University of Michigan Consumer Sentiment Survey, and this might be reflecting some of that personal income falling in April, because here in May, what do we see? Current consumer sentiment down from 88 to 83. So consumers less confident. How about in their current conditions? Went from 97, pretty nice number, down to 89. So consumers are now less confident. And what about expectations? So this is looking forward, went from 82 to 79. So consumers across the board less confident, and yet inflation expectations jumped from 3.4 to 4.6. You want to know who does a terrible job of projecting inflation? Yes, that would be consumers. So now consumers are suddenly worried about higher prices at a time their incomes are going down. And again, you think about what is your natural tendency. If you think prices are going up and your income's going down, you're going to start spending less, because the things you need to buy are going up in price and you're not going to have the income to afford it. Kind of interesting how this inflation story could flip right upside down. Let's take a look at these Treasury auctions, because again, there's some confusing factors that people say there's no demand for bond, or nobody wants bonds. There's going to be all this inflation. Yet, we looked at the 5-year note auction on Wednesday, and I didn't even mention this, a zero, we had effectively a zero bid on the low yield. What about the 7-year? Remember how unpopular the 7-year is months ago, due to that FedWire glitch, no one wanted 7 years, and now low yield of zero. The auction went off really well, and yet investors sold bonds. Isn't that interesting? And look at this, the dealers, what are the dealers holding? Well, in T-bills, they're, sitting on about 16 billion, so no real change. And why do we talk about T-bills? Because we're going to look at this overnight repo thing here momentarily and put some real color to the solution here. But look at this 2-year notes. I mean, down from 45 to 31 billion. So you're seeing demand finally for these two-year and less notes. We had a 3-year auction recently, so that drove that number up. 5-year is up a little bit. 7-year, they're almost at zero. So no surprise, the auction went off well. 10 years, there's demand is definitely there, not a large inventory. And on the 20 and 30 year, it hovers around this 40 billion level, so that's not a big surprise. So you're not seeing dealers really loaded full of bonds. Now, let's talk about this reverse repo thing. A lot of people are making, I think, perhaps a big deal out of something that I'm not sure is there. Now, Jeff Snyder recently wrote a piece on his website, and he discussed how he didn't think this was an issue with bank reserves. There's the speculation that banks are taking reserves and swapping them back to the reverse repo market. And as you know, I don't think that's quite how it works. I don't think banks can do that because those reserve assets are property of the Fed. They're sitting at a Federal Reserve member bank in an account for the commercial bank. So it's held by the Fed. And what my view on this has been, the banks are flooded with cash. And so how do we quantify that? Because if indeed the banks are flooded with cash, why is the Fed doing reverse repo? Or what is the purpose of reverse repo and repo operations? It's to stabilize money market accounts, right? So you want to stabilize them at effectively zero. You don't want them to go negative. Where's our declining yields thing here? So you don't want money market rates to go any down further, because it can't. And it would really panic everyone if they went negative. So how does the Fed manage those money market rates? Well, they use repo and reverse repo, because there's too much cash in the banking system. What happens is just the short-term rates, they're going to go down. So how do you get cash out of the banking system to stabilize money market? Well, you do reverse repo. You do these overnight loans where you swap with treasuries, right? So how do we prove that? How do we prove that? Well, I'm going to show you. And here we have the overnight repo agreements in blue. You can see them. And what's this in red is cash assets at all commercial banks. Customer deposits, right? Commercial, corporate deposits, retail deposits. And you can see as these deposits go up, and no, this is not on a year-over-year basis. This is in billions of dollars each, so we're keeping them the same. Look, you can see as the red goes up, what happens? The repo problem shows up. And as it goes down, the repo kind of goes away, goes up, or there's a repo problem, and it goes down. They both go down, and now all of a sudden, boom, repo spikes as cash spikes. But repo kind of went away. Maybe the banks thought this cash was going to go away, and then it didn't. Cash went up, and now you have a problem. So it does make sense that what we're seeing here is just too much cash in the banks. So I find that very interesting. Hope maybe that will put that story to rest for a while until maybe something interesting comes along. Let's take a look at the assets and liabilities of commercial banks, what's going on this week, because bank credit was up 37 billion, which is good. But wow, a lot of it came from securities in bank credit. So we see here that's up 28 billion with mortgage back up 5. But check this out, U.S. Treasuries that everyone says no one wants to buy, up 15 billion. So banks did find some capacity to buy some Treasury securities last week. How about loans and leases? At all commercial banks, we're up about 9 billion, so that's better than going down. Commercial industrial down 2, that's not so good. Real estate down 6. So where is this demand coming from? Consumers. I know, right? Consumer demand up 9 billion, and where are we seeing that? We're seeing that in credit cards, automobile loans, and then these other loans. I looked that up in the student loans and personal loans. So maybe are consumers borrowing money because of their government benefits have run out and they need it. Cash assets were down over $1 billion, so a big shift there. So I think in today's episode, we could pretty much say, along with our headline story, the decline in personal income, is it going to lead to economic disaster? Is it threatening this recovery? Yeah, because if you look at this whole recovery that we've seen, it's all been funded by government transfers through direct stimulus. Without it, what do we have? Well, we've got almost 16 million people unemployed, and we're about to see that demand go right out the door. Anyways, I'm Steve Van Metre. As always, thanks for watching. Thanks for being fans. Thanks for supporting the show. And I might come in Monday and record a macro show for you. We'll see. We'll keep the Sunday night chart show on Sunday as usual, even though it is a holiday weekend here in the United States. So have a great weekend, and I will see you soon. Bye now. The content of this video is provided as educational information only. Is not intended to provide investor or other advice. It is not to be construed as a recommendation or solicitation to buy or sell any security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre personal capacity. Opinions expressed in this video that do not reflect the Atlas Financial Advisors Inc. or Steven Van Metre Financial.